Gold is the first shoe to drop. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for that, if you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, the best thing to back a token would be gold. So to me, a tokenized gold, right, which would be a token that's stable to the price of gold, that could be used as a medium of exchange, as a unit of account, as a store of value. I mean, people could make payments and receive payments in gold just as easily as US dollars. I think that's a big threat to the dollar. Because one of the things that the dollar had over gold was that it was more convenient to use dollars than it was to use gold.
Renowned economist and financial commentator Peter Schiff recently discussed the deeper meaning behind gold's latest surge. According to him, when gold starts to soar, it's not just a random market move. It's an early warning signal. The rally in gold, he explains, often foreshadows a fall in the US dollar and the bond market. In other words, gold is the first shoe to drop before broader financial shifts unfold. As gold rises, Schiff argues that it reflects growing distrust in fiat currencies and in the long-term value of government-backed debt. He warns that waiting until the dollar and bonds visibly decline means missing the first and most important signal: gold's movement itself. In today's digital age, Schiff also points toward a practical evolution: tokenized gold. By creating digital tokens backed by physical gold, people could make transactions and hold value without relying on the US dollar. These tokens could function as a medium of exchange, unit of account, and store of value, all tied to the enduring stability of gold. Such innovation, he suggests, could pose a serious challenge to the dollar's dominance. Historically, the dollar's strength came from its convenience, but technology is closing that gap. And digital gold could soon make sound money as easy to use as fiat. If you found this insight helpful, don't forget to like, share, and subscribe for more economic breakdowns and market analysis.
China is buying to have gold as a reserve to replace the dollar. And I think that's what a lot of other central banks are doing. They're buying gold to restore gold as, the monetary backing of their currency. And this, I think, is a major, transformation in the global monetary system. I think it's on the order of, or maybe bigger than what happened in the 1970s when we went off the gold standard. And so the world went from having the US dollar backed by gold as the reserve to just having a fiat currency as the reserve. That was a significant shift in the monetary order. But now it's not the US going off the gold standard. It's the world going off the dollar standard and returning to the gold standard. And I think that's probably even more significant, certainly for the United States, because we're about to have the rug pulled out from under us. And, we've been living off of the dollar's reserve status. We've used it as a crutch to live beyond our means. We've enjoyed lower consumer prices and lower interest rates and higher asset prices as a result of this privilege that I think we are in the process of losing. There's no way the U.S. government can repay that debt in money that isn't dramatically debased, meaning that the U.S. government will not be able to raise sufficient tax revenue to make good on its obligations. The Fed is going to have to print the money. And also, we have so much debt now that we can't even afford to pay a rate of interest that would be commensurate to the loss of purchasing power that you might experience holding U.S. debt to maturity. And, that's why Donald Trump is beating up the Fed to cut rates. In fact, that's why the Fed is cutting rates, even though inflation is well north of their, bogus 2% target and headed higher. They're cutting rates when they should be hiking rates. And it's mainly because we can't afford the rates that we have now, let alone the rates that would be required to restore inflation to 2%, right? So we're cutting rates, but we're letting our creditors know that if you hold dollars or treasuries, you're going to lose. We are going to debase what you're holding, and we're not going to pay you a rate of interest that's anywhere near close to compensating you for what you're going to lose to inflation. And so I think given that, the world has made a decision to get out of dollars and get out of treasuries. Why hold U.S. treasuries and earn a 3 or 4% yield if inflation in the U.S. is going to be higher than that And of course, if the US dollar is going to lose more than that in terms of purchasing power on an annual basis. And so rather than holding dollars and investing them in treasuries, they're going to hold gold. I think Wall Street finally recognizes that, yes, gold has a place in your portfolio. And if that's the case, well, this rally has a long way to go, because that means a lot of investors have a lot of gold they need to buy. Meanwhile, the central banks are getting started. I don't think they're nearly complete in their transformation of their reserves. They still have a lot of dollars to get rid of and a lot of gold to buy. You're going to see the weakness in the dollar against other fiat currencies. I mean, clearly, when gold is at 4,000 and it was at 2,000 2 years ago, the dollar's lost half of its purchasing power in terms of how much gold you can buy with your dollar. So the dollar is losing value against real money right now, but so are the pound and the euro and the yen and all these other currencies. But I do think that you're going to start to see the dollar losing a lot more value relative to its fiat counterparts, either before the end of this year or next year. And that's going to accelerate the increase in the price of gold in dollar terms. But I think it's already giving you a forewarning that that's going to happen. I think gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar. And then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? I don't think the Bitcoin is a legitimate alternative to the dollar the way gold is. I think that's how Bitcoin is marketed and promoted by the industry, that it is an alternative, but I don't think it is. I think it's, very different than gold. In fact, it's probably the anti-gold. And if anything, it's more negatively than positively correlated with gold. I think the reason that Bitcoin has gone up is because tech stocks have gone up, and you have a positive correlation there between, high risk speculative assets, and that's where Bitcoin is. Gold has not gone up because it's a speculative asset. It's gone up as a safe haven, as a store of value, as a legitimate alternative to the U.S. dollar. So they're moving sometimes in the same direction, but for different reasons. But I don't think that the stablecoin industry is really going to do much for the U.S. ability to finance its debts, because to the extent that people decide to keep more money in U.S. dollar stablecoins, they're going to take that money out of money markets, for example. And so that's going to reduce the demand for U.S. Treasuries from money markets and just, shift it to stable coins. But I really don't see a lot of demand for stable coins. I think most people today that use them, they're crypto traders. And so they're just parking money there between their trades. I don't see a lot of demand for, the general public to hold U.S. dollar stable coins if they're not using them to trade Bitcoin or Ethereum or any of these things, because you don't get any interest on a stable coin. If I keep my money in a money market, I'm getting like 4% interest. And I've got plenty of liquidity. I can have a checkbook. I can have a debit card. I can use my money market to fund transactions through, like a PayPal or Venmo or, so, why would you give up your interest on your money just to hold a stable coin and earn no interest? I mean, it's a great deal for the stable coin issuers because they take everybody's money and they buy the treasuries and they keep all of the yield for themselves.
According to economist Peter Schiff, the world is witnessing a major shift in the global monetary system, one that could rival or even surpass the events of the 1970s when the U.S. abandoned the gold standard. This time, however, it's not America leaving gold. It's the world leaving the dollar. Central banks led by China are quietly increasing their gold reserves, signaling a loss of confidence in the U.S. dollar and the fiscal discipline of the Federal Reserve. Schiff believes this marks the beginning of a transition away from the dollar as the world's reserve currency and toward gold as a more stable monetary foundation. He argues that the U.S. has long benefited from the dollar's privileged status, enjoying cheaper imports, lower interest rates, and inflated asset prices. But with debt levels soaring and inflation rising, that advantage is fading fast. The Fed, unable to raise rates without triggering a debt crisis, continues to print money, further weakening the dollar's credibility. As nations pivot toward gold and away from U.S. treasuries, Schiff sees this as a warning. The dollar's era of dominance may be ending. Let's get into the interview.
It's always the downside, right? In a bull market, the biggest moves are down. Like in a bear market, the biggest moves are up. And they generally shake out the weaker players. They create a lot of fear that, it's over, time to get out. And they're usually very violent, but they end very quickly. And while a lot of people are frightened of the move, they end up missing out on the opportunity to buy. And I think that's going to be the case with this shakeout. I think gold is going to keep moving up. I think, it's probably healthy that we had a big pullback to kind of keep the speculators in check. The people who come in on leverage and use tight stops, a lot of those guys probably got flushed out in the pullback. We had a big drop in the mining stocks, far more than we did in the price of gold. In fact, a lot of mining stocks ended up losing all the gains, I think, since about 3,700 gold, even though gold is now about 4,100 and change. And there are many gold stocks that are already in bear markets, technically, that in a couple of days have dropped by 20%, as if, everything is falling apart. But we're above 4,000. I think it's interesting that the low of the pullback so far was still above 4,000. So when you're talking about we had this huge sell-off, but gold was still above 4,000. If I sell you something and I take dollars, now I've got to replace my inventory. Well, what if the inventory is getting so expensive that it costs me more to replace what I just sold you? So what might have to happen is that in order to maintain some stability, businesses will move away from depreciating fiat currencies and just work with gold because they know, okay, if I accept gold for my products, when I have to restock, I have gold to pay because prices won't be going up in gold. They're going up in dollars, but they may be stable or going down in gold. So that's the currency I'd rather get paid in, would be gold. And that gold isn't currency. Gold is actual money. What a gigantic waste because the president has decided to make crypto a priority, to have pretty much a crypto cabinet with a crypto czar, and his family has decided to make crypto the family business. I mean, forget about real estate or whatever else they're doing. Their main industry now is crypto and Bitcoin and whatever. And so he's trying to channel all kinds of resources into an industry that he's now, betting on personally. But if you listen to how the crypto industry tries to, to promote itself now, it's basically saying, hey, the government has embraced it. The government has legitimized it. The government is now friendly to crypto. The government's going to have a Bitcoin strategic reserve. And so because of the government promoting crypto, you should invest in it. You should put money in these companies, right? So people are doing that because the government has put its seal of approval on this particular industry, which could end up being a disaster. And I think it will be. I think the whole thing is a giant Ponzi scheme. I think we are squandering all these resources that could have been put to productive use. I mean, the president makes a big deal, and rightly so, out of the fact that our manufacturing is gone and our industrial base is gone. And he thinks we're going to get it back with tariffs. Well, the tariffs are going to backfire and make it worse. But what's also going to make it worse is misdirecting resources that could have gone to building factories to creating meme coins. What the hell are they going to produce? I mean, if we spend all this resources on crypto, then we have even bigger trade deficits because the crypto industry produces nothing, despite all the talk that rates are too high and they need to come down. $4,000 gold is proof that rates are too low and need to go up. Alan Greenspan, when he was Fed chairman, he told the Senate or the House that if gold got to 400, that meant that monetary policy was too easy. That was his way of keeping the U.S. on a gold standard, was to watch the price of gold as an indicator of whether or not he had monetary policy right. And he said, if gold gets to 400, that's telling me that I'm too loose. Well, we're 10 times that price now. So if $400 gold was saying the Fed was too loose, what is $4,000 gold saying? So yes, we have all kinds of bad loans, including the U.S. government, right? The U.S. government has borrowed much more money than it can ever repay. It has borrowed more money than it can service. But the only reason we have $38 trillion in debt is because interest rates have been kept so low for so long. If interest rates were much higher, the government couldn't have borrowed all this money. We couldn't have afforded it. So we would have been forced to cut government spending years ago, decades ago, if it had not been enabled by the Fed.
The surge of gold past $4,000 isn't just a market move, it's a message. It's telling us that faith in fiat money, especially the US dollar, is breaking down. While the Fed continues to keep rates artificially low, the real world is pushing back. The price of gold reflects the erosion of confidence in central banks, government debt, and the illusion of endless money printing. Instead of rebuilding America's industrial base or tackling fiscal irresponsibility, political leaders are chasing the next speculative wave crypto. But as gold quietly climbs, it's becoming clear which asset represents real value and which one is built on hype. Businesses and investors are starting to realize that holding wealth in something tangible, something real, may soon be essential, not optional. If $400 gold once signaled easy money, then $4,000 gold screams crisis-level policy failure. This isn't just about the metal, and it's about what it says regarding trust, discipline, and the future of the global financial order. Gold isn't rising by accident, it's responding to reality. That's the warning and the opportunity. Thanks for watching. Don't forget to like, share, and subscribe for more economic insights.